Good morning. Thanks for your company. This Thursday, the 17th of September, I'm Jessica Amir, market analyst with Bell Direct. Well, US stocks mostly fell overnight, their first fall in 3 days after the US Federal Reserve shaved its economic growth forecast for next year down to 4% from 5%, also shaving 2022's forecast GDP to 3%. However, growth this year was upgraded from a negative of 6.5% to a fall of just 3.7%, but there were some expectations that rates would be dropped, and this is perhaps why we saw the Nasdaq retreat a 1.25%, which erased the prior day's gain. The broader S&P 500 also down 0.5%, erasing the prior day's lift as well. But the Federal Reserve did pledge to keep rates near zero until 2023, which gave industrial, discretionary and economic cyclical stocks a bit of a kick, like Chevron, Walgreens and Boeing, which rallied between 2.4 and 2.9% each, which helped the blue chip Dow Jones lift about 0.3%. On the commodity side of things, the oil price had its best one-day rally since June, surging 5%. It's now above $40.17 US after Hurricane Sally made landfall, keeping US Gulf Coast output shut. Meanwhile, US crude supplies have continued to fall. They're now at their lowest levels since April. The gold price has lifted 6% US compared to yesterday. It's now 1,967 US an ounce. The Aussie dollar is holding its own, 73 US cents. That's a 3-week high. What to watch today? The focus is on employment numbers, which are out for August. We know that employment has been trending high. 115,000 people, in fact, gained jobs in July, but forecasts for August are quite dire given Victoria's lockdown. The unemployment rate is likely to worsen today from 7.5% to 7.7%. The RBA is expecting that unemployment will rise to 10%. If the number is less, the market should rally. If it's worse, expect a pullback. So far, we do know the Aussie share market rose 1% yesterday, and the futures are already suggesting a bit of a pullback, a fall of 0.2%, really following Wall Street's mixed session. So today, if you're looking for a bit of growth, I'd be looking at oil stocks, given the oil prices lifted 8% in 2 days. So look out for Oil Search, Origin Energy, Santos, Woodside Petroleum and WorleyParsons, all of which are undervalued and buys as far as UBS is concerned. As for trading ideas that may be worth a look, Temple & Webster, Netwealth and Breville are all giving off strong bullish signals according to Trading Central's charting. As for QBE, the British High Court has ruled QBE is in favour of 2 of the 3 COVID-19 insurance case payouts. Now, this reduces QBE's UK business interruption costs to $70 million US. Goldman Sachs says this is quite manageable, even though it is above its QBE's catastrophe budget. Bell Potter reiterated QBE as a buy, but shaved its price target to $11.10 as a result, which still implies 21% upside in a year from yesterday's close of $9.20. So that's QBE, a Bell Potter buy. And A2 Milk, a different story. It's been called out as a sell by Citi, garnering quite a bit of interest as that's just one of the 3 sells in the market amid a sea of buys. Citi thinks there's headwinds building for Daigou interruptions, which is impacting its sales. Citi also thinks the outlook is getting increasingly risky given the resurgence of Chinese brands. Of course, you've got the regulatory landscape, which is getting quite complex, and increasing geopolitical tension. You also got a potential inventory buildup, and the entire Daigou channel remains disrupted. No likely sign of a recovery in travel anytime soon, all of which is why A2 Milk has been downgraded to a sell, coupled with the fact that it's trading at 29 times forward earnings, all of which are reasons why Citi thinks it's too frothy and there's quite a lot of risk in A2 Milk, which is why it's a Citi sell. That's it for today. Stay safe. Happy trading.